So as of today, are we in a bubble in US equity markets?
I don't like using that word because it comes with a sense of arrogance. Bubble basically says, I'm the smart one. I'm the rational one. Look at these crazy, shallow people pushing prices up. Are US stocks richly priced? Absolutely, by every metric. Price earnings ratios, just looking at the level of the index. But I'm not willing to draw that jump and say, okay, it's a bubble, because bubble essentially means there's a correction coming. And here's why I think we've got to give the equity market some slack. First, if you look at US company earnings, not just in the last year, but over the last 15 years, it's remarkable how US company earnings have become far more resilient. It's almost like companies have learned to keep earnings going in the midst of crises, in the midst of changes around them. Barring the COVID correction, which was understandable, the entire economy shut down. And even then, think of how quickly earnings came back. So the first force that's driving the market is that earnings have continued to grow this year, in spite of all the negative talk, in spite of all the tariff talk. And 75% of US companies have beat earnings expectations this year. So as analysts have expected lower earnings, they've beaten the expectations.
And get to your kind of valuation model, because they assume a degree of political stability, right? But the reality is you've had wars, trade wars, you've had fiscal stress, you have US election uncertainty. You think that we're underpricing some of the tail risks and we should be rating some of the valuations.
I'm not expecting political stability. I'm just saying political instability is impossible to forecast ahead of time. It's the same thing I would say about any kind of uncertainty. Maybe this is an instability where there's far more downside than upside. And there's an argument that maybe the market is not building in enough of the downside into its pricing of equities. I mean, that's an argument we've been hearing since March or April of this year when the tariffs came into play. You're saying there's not much upside from this. There's so much downside. Why isn't the market doing what we'd expect it to do? And this is, you could take this back 4 years. I remember hearing this during COVID. It's, exactly the same argument. At the end of the process, though, if you look at who's been right, markets or experts, every single time, markets have been right and experts have been wrong. If anything else, in the last 4 years, I've learned to think a lot less about what experts think about the economy and a lot more at what the market is building in an expectation, because I don't think experts have any idea what they're talking about anymore. And if you consider me an expert, I would include myself in that group.
Any other markets or stock specific outside of the US, if somebody wanted to, to diversify away from, because you've made the point that they're richly priced. So if I want to find other opportunities, where are they? What are you looking at? What's on your list?
I think it's time for investors everywhere, but especially in the US, to look outside the US and bring stocks in. I think Europe is full of boring, not great companies, but it's also full of boring, not great companies that might be good investments to have in your portfolio. And I will let people make their decision on what parts of the market they're comfortable with. If you're going after mature companies, Europe is the place to be. If you want to go after growth companies, you probably have to go to Asia and Latin America because that's where the growth is. You're not going to get too many great growth companies in Europe. But I think it's time you enrich your portfolio by looking outside the US.
The Middle East has gone through a lot of reform in the last few years to try and bring more capital in. And sort of Saudi Arabia, the United Arab Emirates, they've kind of led the charge. So I'm wondering where the Middle East fits into that, be it the UAE or Saudi Arabia. Maybe Qatar is would be the third one to put in there because they've done the capital markets reform and you can easily buy stocks from, your preferred brokerage in New York City. So could you talk to us about that a little bit?
Okay. I'm going to tell you a story that has nothing to do with the Middle East as to why I think the Middle East is going to struggle to get its capital markets flying. Now, a long time ago, I was in Singapore and I was talking to the regulator of Singapore equity markets and was talking about the fact that a lot of money was leaving Singapore and going to Hong Kong and Tokyo and Frankfurt. And he said, how can we make Singapore the center of the financial universe again, where people... And I said, I'm going to tell you what you need to do, but you will not do it. And he said, what do you mean? And he said, look, markets need chaos. That's the nature of markets. You need to let people overreach, correct, make mistakes, and deal with the consequence of the mistakes. You need to have disorder for markets to actually function. And I said, just look out of the window at Singapore. What do you want? You want order. You want you want Disneyland in your city, everything run. And I love Singapore because everything is orderly. But when you look for order, it's very difficult to have financial markets flourish, because what you look for in financial markets is you let people make mistakes, big mistakes. I mean, you started with the word bubble, and I wrote a piece a while ago that got me a lot of blowback saying, what's wrong with bubbles? They say, but they burst. People get hurt. But every bubble that's burst has changed the way we live as human beings. .com bubble burst, right? People lost their jobs, they lost their money. But guess what? It changed the way we live. It's human nature to overreach. That's what we call a bubble, and then correct, and then say, I'll never do that again, and repeat it on an entirely different thing 5-10 years later. Don't be so protective of investors. If you try to protect your investors too much from bad companies, bad investments, stupid mistakes they might make, you cannot have a vibrant market. You got to allow for mistakes. You got to allow for people to deal with the consequence of their mistakes, and not be so quick to bail people out or cut back on their overreaching.
Professor, to what extent are you including crypto plays in your personal portfolio? So a shift away from equities to alternatives. Where do you stand on that today?
Let's step back. What do investors do? What's the essence of investing? You value a company, and if the price is less than the value, you buy at that price, and you hope and you pray, and you hope and you pray that the price goes to value and you make money. That's the essence of investing, right? You cannot invest in Bitcoin. You can trade it. And here's why. Bitcoin cannot be valued. And this has nothing to do with not being a fiat currency. Fiat currencies can't be valued either. You can't value the dollar, you can't value the real, you can price them. That's what an exchange rate is, based on how good or bad they are as currencies. But you can't value them. If you can't value something, you can't invest in it. You can't invest in it, you have to trade it. How do you make money trading? You buy at a low price, you sell at a high price. And that indirectly answers the question why I would not put Bitcoin in my portfolio. It's a traded investment. And to be in a traded investment, you got to be good at detecting mood and momentum and shifts in those. And I'm not good at that. There are others who become very rich on Bitcoin. I don't begrudge them. But there are other crypto plays as well, right? Crypto is a big space, and companies that make money on crypto. So Coinbase, I don't own stock in, but I'd be willing to buy Coinbase at the right price, because it's a business. It makes money by people trading crypto.
Are you surprised that there's been so much institutional adoption of, Bitcoin and now more recently Ethereum?
Not at all, because I know what drives institutions. It's Fomo. People assume institutions are full of these wise people who look at valuations and decide. Institutions are the biggest sheep in the investment world. People talk about retail investors running after the crowd. Institutions are the biggest crowd chasers. Their biggest worry is being out of the next big one, whatever that next big one is. So whether it's AI or crypto, they're afraid of being left off. And I'm surprised it took them so long to join in. The only reason they weren't joining in was because of regulatory constraints and what they could. It terrifies me that those regulatory constraints will be removed. You could have mutual funds investing in Bitcoin, and pension funds investing in Bitcoin, and endowment funds investing in Bitcoin, because they would chase price increases in the last period and end up losing us all money.
So it sounds to me like you're saying this is an apparent regulatory failure, that this should have been stopped in its tracks, given the potential, the potential systemic risks.
Yeah, I think there's a fiduciary problem here, which is endowment fund managers, for the most part, are inept. Giving them more power is a license for them to be even more inept with your money. Now, the essence in investing is less is more. And most endowment and investment managers don't get that. And you can add Bitcoin and crypto and whatever else they'll add to the space, because that's where they're going next. Is they're looking for the next magic bullet, because they want to figure out an easy way to make money. And unfortunately, there are no easy ways to make money.
What advice would you give to those who are starting out on their investing journey? Be it younger crowds or people who are close to retirement. Even what would you tell them?
think of investing as preserving and growing your wealth. Not getting wealthy, but preserving and growing your wealth. To preserve and grow your wealth, what do you first need? You need inflows into your fund, right? Where do you get the inflows? By working a job as a doctor. So if you're a doctor, an engineer, or a scientist, do your job well first. Earn an income, save portions of it, and use investing as a way to preserve and grow it. The reason I say that is that a lot of young people who are doctors who are spending their lunch breaks rather than reading up the latest medical journals, checking out the stock pages. Because for them, investing has become this quick way of getting rich. No, I'm not making enough money as a doctor, so I'll use investing as a way. That's a horrendously dangerous way to start your investing journeys, by saying, I'm going to invest because it's my easiest pathway to getting rich. And once you decide that investing is a way of preserving and growing your wealth, go slow. Do things incrementally. Don't overreach. Less is more. One of the most enduring findings when people look at active investing is the more active you are, the lower the returns you make.
Right? Yeah, the data is more. The data is very clear on that. It's, I mean, you can't find any more consensus on that.
The more information we get on markets, the worse our returns seem to get. So stop watching CNBC, stop consuming so much financial news, stop listening to every financial news. Except a podcast, maybe. But I think we spend far too much time on markets and investing and far too little time on the rest of our lives. The longer you stay around markets, the more humble you get about the things that are out of your control. I mean, that's, 40 years ago, if you asked me what I thought about karma, I'd have said that's an Indian way of thinking about things. We control our destiny. 40 years later, my answer is so much of what happens out there is out of your control. And that's a healthy recognition to get, because first, it'll make you less arrogant when you win, because you realize that you got there mostly because you were in the right place at the right time. I didn't pick NVIDIA in 2018 because I thought AI was going to be a big thing. I didn't even know what AI was, at least in the form it is today. I just got lucky. So the first, and the second is it'll give you the capacity to forgive yourself when things don't go right, that you don't blame yourself, because you recognize that sometimes you can do everything right and end up losing money through no fault of your own. So to me, the biggest lesson I've learned is to accept things that happen as saying, hey, I did the best I could. And in fact, it helped me fight what I think is we talked about FOMO and how that can lead you to chase. The second biggest problem in markets is Romo. Regret over missing out. If only I'd done this, if only I'd done that, if only I'd done the third thing. And that is so damaging, because once you start to feel regret, it starts to eat into how you invest and where you invest. And I don't have much regret about, any of the things I do. I buy something and it doesn't go well. I say, okay, I learned my lesson. And I would say the same thing is going to be true about, if I do things and something goes right, I say, okay, that was good.
There's always so much noise, and the noise keeps getting more and more, right? All the notifications and more devices, and it's hard to get away from that. How do you get into your zone of focus? How do you get dialed in?
Be lazy. Have a vacant mind. No, and I'm serious. I think much of what I write comes about because I don't have a phone with me distracting me. I take my dog for a walk without any devices, and for 40 minutes, my mind is empty in the traditional sense. I'm not listening to a podcast. I'm not reading anything. I'm not listening to something. I'm not looking up at Facebook. I've discovered that you need to give your mind some room to connect disconnected thoughts. Almost every one of my writings, so that's a blog post, comes about because I let my mind kind of let things work themselves out. Different strands of thought that connect. I tell people, look, if Isaac Newton, sitting under the apple tree, had a smartphone in his hand, was checking out Facebook, and an apple had fallen on his head, we wouldn't have the laws of gravity. We would have cursing about how the apple distracted him from reading the latest Facebook post. How the heck do you go from an apple falling on your head to the laws of gravity? And for that, you got to have some time to think. It's almost like technology companies have conspired to make us replaceable by AI by taking every portion of our time and filling it in with what we think is critical stuff to do. I mean, I challenge you next time you're getting ready for a flight, when you're at the gate, to look around you at what everybody's doing. Everybody's checking out their smartphones. Nobody has time to just daydream. So my advice to people is daydream more. Read less. No, don't be so concerned about filling your mind with information. Let your mind kind of find its own way to answers.